When macroeconomic conditions become turbulent, capital naturally flows away from risk and towards certainty. Investors scan the market for safe harbors, companies with enduring consumer demand and decades of reliable returns. In the first quarter of 2026, you will find few businesses performing as reliably as Colgate-Palmolive. Trading at around $91 a share, the company commands a 41.1% share of the global toothpaste market. The qualitative metrics are high. First quarter net sales grew 8.4%. The company generated $747 million in operating cash flow in just 3 months, and they have increased their dividend payout for 64 consecutive years. But this presents a problem. A reliable business operation does not automatically translate into a sound investment. Buying a company with defensive fundamentals at the wrong price can erode your capital. To find the true intrinsic value of Colgate-Palmolive, we are going to strip away the brand narrative. We will run the company through a valuation gauntlet, testing its financials against the frameworks of the Warren Buffett model, the Peter Lynch approach, Benjamin Graham's checklist, and a discounted cash flow model. Relying solely on brand recognition and a dividend streak exposes you to a hidden cost, overpaying for business quality at the expense of investment value. We begin with Warren Buffett's framework. He requires 3 qualitative pillars before looking at the math: a wide economic moat, pricing power, and consistent management. Colgate passes Miss Initial screen. Their 41% market share represents a global moat, and they executed a 2.2% pricing increase in Q1 without reducing consumer demand. This chart comparing total assets to equity reveals a distortion. Decades of share buybacks reduced shareholder equity to $145 million, under $16.6 billion in assets. Against this, debt is $7.97 billion. But with an annualized $2.44 billion in free cash flow, leverage is manageable. Buffett values a company based on its owner earnings. We calculate this by taking Colgate's $747 million in Q1 operating cash and subtracting the $138 million required for capital expenditures. Annualizing that result gives us $2.44 billion in pure, distributable cash. Using Buffett's intrinsic value calculation, we apply a 10% discount rate and assume a 3% perpetual growth rate. This values Colgate-Palmolive's future cash streams at roughly $34.8 billion, or about $43 per share. At the current price of $91, Buffett would reject the stock. Despite the business quality, buying in at this level provides an owner earnings yield of 3.3%. That leaves no margin of safety. Next, we evaluate the company through Peter Lynch's methodology. In his framework, Colgate-Palmolive is a stalwart. A stalwart is a large, mature enterprise that offers slow to medium growth and downside protection during recessions. You buy them for stability. Lynch measures value using the PEG ratio. This equation takes Colgate's trailing price-to-earnings ratio of 23.5 and divides it by management's maximum organic growth guidance of 5%. The resulting PEG ratio is 4.7. Lynch requires a PEG under 1.0. A score of 4.7 places this stock well past that threshold. Furthermore, Lynch avoided companies with heavy institutional ownership and levered balance sheets, both of which are prominent features of Colgate's current profile. The danger of the stalwart category is straightforward. Buying a slow-growth business at a growth stock multiple often leads to PE compression when market sentiment normalizes. We turn now to Benjamin Graham. His defensive checklist ignores future growth narratives, prioritizing asset safety and downside protection. Graham requires a current ratio of at least 2.0 to ensure short-term liquidity. Colgate's current ratio sits at 1.03, failing his minimum standard. Because share buybacks have reduced the equity pool, the company's price-to-book ratio is over 500 times its accounting value. We can plug these specific variables into Graham's classic intrinsic value formula, combining the annualized Q1 earnings of $3.88 per share with the book value of 18 cents per share. The math results in an intrinsic value of just $3.96 per share. The formula breaks down because modern capital structures rely on share buybacks. This practice conflicts with Graham's requirement for tangible book value as a safety net. Based on Graham's criteria, the stock fails to provide the tangible asset backing required for a defensive position. A buyer today cannot rely on asset liquidation value for downside protection. To find the mathematical ceiling of Colgate's value, we strip away the qualitative narratives and build a modern discounted cash flow model. We anchor the model with these assumptions: $2.44 billion in free cash flow, a 4% 5-year growth rate, a 7.5% cost of capital, and a 2% terminal growth rate. This waterfall chart builds the enterprise value by combining the present value of the projected 5-year cash flows with the terminal value, yielding an enterprise value of approximately $48 billion. We then adjust that figure by subtracting the existing debt load and adding back cash. Dividing that resulting equity by the outstanding share count reveals a fair value of $51.60 per share. Because forecasting relies on assumptions, we visualize variations using a sensitivity heat map. Even modeling an optimistic scenario, dropping capital cost to 6.5% and pushing long-term growth to 3%, the value we generate is $72 a share. To mathematically justify the current $91 price, capital cost must fall below 6%, while long-term growth accelerates. This is improbable. Running a secondary validation check using the dividend discount model arrives at a correlated value of $54.59. The data shows a $40 gap between the company's intrinsic value and its current market price. If the math maxes out in the low $50, we must ask why the price is $91. We find the answer using a reverse DCF to see what the market is pricing in. Working backward from $91, the current valuation demands nearly 10% perpetual free cash flow growth. Colgate is a mature manufacturer operating in saturated global markets. 10% perpetual growth is structurally unlikely. This valuation gap points to a specific market behavior. Market participants are treating this equity like a high-yield bond. They are paying a premium for the perceived safety of the business and its reliable dividend yield. By paying for operational safety, investors are accepting valuation risk. They are overpaying for reliability. This table compares our intrinsic value models against the $91 market price. Operationally, Colgate is strong. Its market share, pricing, and dividends prove it is a well-run business. But at $91, it offers no margin of safety across these frameworks. Our verdict on Colgate-Palmolive is a hold for existing investors, but we advise against initiating new positions at current levels. Entry parameters require patience. DCF and dividend investors should look for a pullback into the $50 to $55 range. Buffett disciples require a larger margin of safety at the $40 to $45 level. Operational strength does not change the laws of mathematics. Overpaying for a stable company often turns a safe business into a high-risk stock.